Hey, it's Steve. In this video, I'm going to walk you through the different legal entity structures that exist in the United States and what I wish I would have known back in the day when I was starting my first company. Just as a disclaimer, this is for informational purposes only, so make sure you consult your own legal counsel for advice specific to your situation. Let's go ahead and jump in. Now, there are different legal entities that exist out there. We're going to start with the most basic form, which is DBA, also known as a sole proprietorship or just doing business as. So if you want to start a business and you're not sure you want to go through the process of forming a legal entity, creating a website, getting business cards, all this stuff, and if you just want to test things, you can start selling products and services right now. And you can do this as a sole proprietor, and you're basically just leveraging your social security number when you go to file your taxes and you report the income and expenses of this enterprise. This has the most risk, although it's the easiest to set up, because you will be personally liable for all liability within your company. So this right here, sure, it's easy to set up, but I would definitely recommend avoiding this because you can't have any stock in this business as well, so it limits investors and everything else. So yeah, it's easy to set up if you just have a side hustle, but it doesn't limit you from any liability, so hence I would avoid it. Okay, the next structure I want to mention is an LLC, which stands for a limited liability company. All right, so you can form this pretty easily. A lot of the businesses that I've started and that I've ran, even big companies, when I was CFO of a solar company, we were doing over $400 million a year as an LLC. So this could be a really good structure that limits liability and it creates a lot of flexibility within the business. Now, you could be taxed by default as a partnership, as an LLC. And what this means is that if you do nothing, if you just form an LLC, you're taxed as a partnership, and any money that you make in this business, it flows through, this net income flows through to your personal taxes, right? And this comes through a K-1. So just all the money right here flows through the partnership, comes here, you pay taxes on it. The LLC itself does not pay any taxes because it's treated as a disregarded entity, right? Now, I'm going to get into this in a second here, but you can file a specific election to be treated and taxed as an S-Corp. You're still an LLC, but you could be taxed as an S-Corp instead. I'll get back to that here in a second. Let me just keep going with the different entity types. The next type of entity is a subchapter S, or also known as an S-Corporation. This is an actual corporation that you can form. This too is a pass-through entity, so the net income that you earn is reported on the K-1 and it's hitting the personal tax returns of owners of this S-Corp, right? So the S-Corp itself does not pay any taxes. Instead, that money just flows through, and individuals of the S-Corp, they end up paying the taxes in the business. And then we have a C-Corp. And this entity structure is really common with publicly traded businesses. Now, one thing is that the C-Corp does pay taxes. So it pays taxes and then it distributes money to individuals. And then these individuals have to report those dividends on their taxes, and then they pay taxes as well. So this is where you get double taxation with a C-Corp. All right. Now, there are a lot of other pros and cons with the C-Corp that I'll get into here in just a minute. But for now, let's just keep it focused on the DBA, the LLC, the S-Corp, and the C-Corp. The only other type of entity structure that I'll mention that I'm not going to get into is just a partnership. If two people come together and they want to form an entity, they can join in a partnership. There are for sure disadvantages with partnerships. They can work out, but I can tell you they're oftentimes unstable because of the decision rights and just disagreements that can happen between two partners, and then the whole entity blows up. But for now, I'm just going to focus on the DBA, the LLC, the S-Corp, and the C-Corp. All right, let's get into some bonus material. If this is making sense, can I get a yes below in the comments box? Also, if you're listening to this and you already own a business entity or multiple entities, drop a comment down below and let me know what type of entity structure does your business currently have. That'll be really helpful as I read through the comments and understand who the audience is in this video. And also along the way, you could drop comments in there if you have feedback or if you want me to go deeper into any of these topics, and I'll produce additional content to drive more value specifically to your needs. All right, let's come back here. I think we understand the DBA, the LLC, the S-Corp, and the C-Corp. Let me get into the nuances here. Here's the bonus content. A lot of accountants out there are always trying to look to create value for their clients beyond just doing tax returns or doing audits for their companies. All right, so this is what they do. They often say, look, if you're an LLC, automatically remember your tax is a partnership. If you file this form 2553, IRS form 2553, if you file this form as an LLC and you meet certain criteria, then they'll allow you to be taxed as an S-Corp. All right? This doesn't mean that you become an S-Corp. This is really important to understand because when I'm working with clients, I'll say, okay, what's your business entity structure? And they'll often say, okay, I'm an S-Corp. But legally, they're an LLC. They just mean that they're taxed as an S-Corp. It's important to differentiate between the two. But if you fill out this election, you get the rights to be taxed as an S-Corp, then accountants say, look, I just added so much value just by filling out this simple form, and I'm going to save you all this money in taxes. Okay. Now, this is a misnomer, and if you're not careful, you could definitely be misguided in this area. It doesn't mean that converting to an S-Corp is necessarily a bad idea, but there are some caveats you should definitely consider. And this is what I wish I would have known when I was first starting out and I created my first entity with the guidance of my accountant. All right, here are the limitations with an S-Corp. Whether you're taxed as an S-Corp or whether your structure is an S-Corp, you can, number one, as an S-Corp, you can only have one type of stock, which is definitely limiting. Number two, you can only have U.S. individual investors, meaning that entities can't own an S-Corp. Think about it. You go to raise capital from an investor, and maybe it's a family office or a wealthy individual who has their money tied up in another entity, and they want the entity to invest in the corporation. So for example, I may want to put money into a business, but I want to do it as Steve's Capital LLC, not as Steve Coughran Personal. I can't do that in an S-Corp. Only individuals can invest in S corporations. So obviously that's another huge limitation. When it comes to distributing capital, you have to do it proportionally in a pro rata manner to all individual investors. In other words, in an LLC, you can take disproportionate distributions, meaning one person can take money out of the business and nobody else has to take money out of the business at the same time. In an S-Corp, if one distribution is made, it has to flow through pro rata to all individuals that own stock in the S corporation. And then the big thing is there's compliance costs. So as an S corp, you have to meet certain regulations, you have to perform certain actions, you have to document meetings, you have to run the business as an S corp. Otherwise, if you're just an LLC, but you're trying to be shielded by an S corp, and there's an issue with liability, there's something called piercing the corporate veil. And if somebody really dives into the structure and the function of the S-Corp, and it's not really being ran properly like a true corporation, then they can pierce that liability protection and come after you. So you have to be really careful of that. And there's this phase out too. So let me explain this. I'll create a little bit of room up here. And let's just say with an LLC, you have revenue, you have expenses, you have profit. And like I said, this profit flows down to an individual. Okay, this is just an LLC taxed normally. It flows through to the individual, and then the individual has to pay self-employment taxes on all of the profit of the business. And that self-employment tax could be, pretty high. So what accountants say is they're like, all right, instead, if you file this S-Corp election that I was referring to by filling out Form 2553, then you have revenue, you have expenses, and a part of these expenses, you're going to pay yourself W-2 wages as the owner of a business. So you set a salary for yourself. Let's just say $100,000 you're going to pay yourself as a W-2 employee. And this $100,000 is subject to payroll taxes, which you pay personally and is matched by the company. All right. So this is how you get paid as a W-2 employee. Now with an S-Corp, you'll end up with profit, hopefully. And the idea is you can take distributions out of the company, and these distributions are not subject to the Medicare, Social Security, FICA match. And this is where you're saving money. And this is the whole thesis of accountants. If you form yourself as an S-Corp, you pay yourself W-2 wages, you pay yourself a reasonable salary, then when you take distributions, those distributions are going to be taxed at a lower rate, and therefore you're going to save the 7+% taxes that you would otherwise pay by matching Medicare and Social Security. But here's the deal. There is a phase out on Social Security, so that's only up to a certain amount. So if you're earning a large sum of money, this structure may not necessarily work. Also, you have to pay yourself a fair market salary. You know, you can't pay yourself $50,000 in a salary, W-2 wages, and then take a $500,000 distribution because you want to avoid the additional taxes. So there are a lot of nuances here to uncover, but the big thing is, as I pointed out with the limitations of an S-Corp, if you form a business that's an S-Corp early on, and then later on you want to raise capital, so your business starts to grow and you bring in capital, you're going to have a lot of restrictions as an S-Corp, as I mentioned. And this can be very problematic because if you go and try to convert from an S-Corp back to an LLC, or you go from an S-Corp to a C-Corp, there may be some tax triggers which cost you a lot more money in the long run. Also, the worst entity that you could be in to own property or real estate is an S-Corp. So if you form yourself as an S-Corp and then let's say you buy your own office and you keep it under that S-Corp, which I wouldn't recommend. I'd recommend creating a separate entity that holds the real estate. But a lot of businesses will own real estate as an S-Corp. It's a terrible structure and you're going to be paying a lot more in taxes. So I just wanted to point out some of these differences here because I didn't understand this when I first started out in business. And then as a CFO, as I go in and turn around companies or I build companies or I spin off companies, if they have the wrong legal entity structure, it's really difficult to make certain strategic moves. As a CFO of a large company, we were doing $1 billion in revenue and it was set up as an S-Corp. And it was super limiting because we couldn't raise capital at the holdco level, at that S-Corp level. So the S-Corp owned a series of other LLCs underneath it because S-Corps can own LLCs. You just can't have an LLC or an S-Corp or a C-Corp own an S-Corp. So as we were looking at bringing in outside capital, it was super limiting because we couldn't do it at that S-Corp level. And if we converted our entity structure at this point, there are going to be some massive tax implications. So that's why I wanted to walk you through these different entity structures from a high level and just point out a few things. Like I said, this is for informational purposes only. If you want more specific advice, definitely go to your legal counsel and they'll be able to help you. But at least now, I hope that you're armed with enough information to pinpoint some serious traps that you may get into. Thanks for joining me for this video. Be sure to subscribe if you want to be notified when I drop new videos in the future. And in the meantime, take care of yourself. Cheers.